Good afternoon and welcome everyone to NFF's 14-part Financial Management webinar series. We're so happy that you've joined us for today's session on strategic budgeting. I am Rashi and I'll be facilitating today's webinar, which is being presented by Alice Antonelli, who is a director in our advisory services team. We both are actually joining you guys from the NFF Philadelphia office. Before we get started, I would just like to go over a few housekeeping items. This webinar is being recorded, so everyone is muted to ensure high sound quality. However, we want this webinar to be interactive, so you can send your questions as they come up during the course of the webinar. You can do that by typing them into the chat box that is located on the bottom of the webinar panel. So I'll be able to respond to you via chat right away, and I'll then relay your questions to Alice on the air during our question and answer sections. Within 24 hours following the conclusion of the webinar, you'll receive a link to the recorded session, the PowerPoint slides, and any supplementary materials that we share that will help you apply the concepts we'll review today. The email will come from an nff.org email, so just be sure to check your spam if it doesn't arrive. If you would like to access the presentation slides now, you can do that by downloading them from the handout section. You might have to expand the handout section by clicking on the small arrow that is next to it to actually access the document. So without further ado, I'm just going to hand it to Alice to begin the session. Alice, to you.
Great. Thank you, Rashi, and good afternoon, everybody. So as Rashi mentioned, today we're going to talk about strategic budgeting. Your budget can be a core management tool to align staff and board around the financial goals such as growth, stability, or change. Today we will learn how to set up a budget that appropriately communicates your organization's comprehensive financial needs and future plans. Before I begin, just a little bit about Nonprofit Finance Fund for those of you who don't know us. NFF is a nonprofit organization with offices around the country. We've been around for 37 years providing loans and investments to nonprofit organizations, providing advice on strategic financial management, and lifting up what we are learning on the ground to share with others in and across the sector through advocacy. So in this webinar series, we bring not only our work from across the entire sector, but also our history working with nonprofits of all kinds in many different ways. This slide is an overview of the webinar series. We developed this webinar series to help you own your numbers, tell your financial story, and make data-informed decisions. Part 1 focused on core financial literacy. Part 2, which we're in right now, is focusing on day-to-day tools for financial communication and reporting. And then Part 3 will present the different kinds of tools that you can use to strengthen your financial management decisions. So today, we're going to do a number of things. First, we're going to review a few key financial concepts as we prepare our way to learn about strategic budgeting. We're also going to use a case study to explore different budgeting strategies to mitigate risk and pursue opportunity. We will then learn about revenue strategies to help you plan and navigate the future. And at the end, you're going to be able to take home a budget template that includes options for below-the-line budgeting, forecasting revenue, and also multi-year projections. So in the previous webinar, my colleague Dominique Hug took you through the who, what, and whys of budgeting. In addition, she also covered such topics as how to budget for restrictions, and she gave us tips on reforecasting your budget. If you are new to budgeting or feel that you could use a refresher on the basics, I encourage you to download a copy of her webinar. With the basics having been covered last week, now we can take the conversation up a level. An important part of strategic budgeting is knowing and identifying uncertainty and risk so that we can plan accordingly. So first, we need to define risk. There are 3 general types of or categories of risk. 1, unavoidable. the risk as a result of human error and bad systems. And my apologies, I said unavoidable, I meant avoidable. So the risk as a result of human error or bad systems. Strategic risk, risk taken when pursuing something favorable, and there it is, unavoidable, the risk which is out of our control. Some of the risk we face, we can control or mitigate through strategic budgeting. For instance, budgets fit into our financial system. We can create strong budgets to mitigate some avoidable risk, and it would be helpful to have a good system in place in which to project future activities. Budgets can also help with quantifying strategic decisions and initiatives. And we can use and adjust our budgets to help mitigate or minimize unavoidable risk. So, what's strategic budgeting? More than just a list of revenue and expenses for the year, let me suggest that strategic budgeting incorporates these 8 guidelines and principles. So, the first item on our list, the strategic budget links financial decisions to mission and strategic direction of the organization. Next, the strategic budget presents the total costs of major goals and priorities. While a strategic plan may be designed with a logical flow from mission to the ultimate goals, plans often fail without quantifying the implementation cost of those ideas and objectives. Next, the strategic budget invests in infrastructure, particularly human capital needed for the strategy to succeed. In order to accomplish future plans, you may need to do a current assessment as to where you are at the moment. What investments will you need to make? Do you have enough folks in your finance department? How about your development department or human resources? Perhaps you run a much smaller organization and you, the executive director, have been taking on all of these roles. While we won't get into too much detail on this topic today, it really is an important one to consider before you take on growth or make any major changes to your strategy. Number 4 on the list, the strategic budget invests in longer-term capital needs of the organization by incorporating the full cost of operations. Number 5, the strategic budget forecasts revenue in a very thoughtful and systematic way. Number 6, the strategic budget connects the annual budgeting process to multi-year financial plans. The strategic budget maintains flexibility by creating what-if scenarios and contingencies. We all know a host of issues can upset even the most meticulous of plans. This topic will be covered in more detail in a future webinar. And lastly, the strategic budget evaluates assumptions, actual results, and outcomes. Strategic indicators, qualitative and quantitative, keep all levels of and phases of the plan connected to reality. As we only have 1 hour, we will not cover everything today, but we will hone in on a few key components of this list. How to think about investing in longer-term capital needs, forecasting revenue, and developing those longer-term projections. First up is planning for longer-term capital needs. So what do we mean by this phrase, and how does it relate to mitigating risk? One of the ways that we can mitigate risk is to increase reserves, which are recorded on our balance sheet. So just as review, you may recall in our past webinars that we said that surpluses build the balance sheet, deficits weaken the balance sheet, and a healthy balance sheet can help mitigate risk. One way to build a balance sheet or reserves and address longer-term needs and investments is through the creation of surpluses. Surpluses are critical for addressing our longer-term needs. Like any organization, nonprofits or not-for-profits need to cover the full cost of delivering programs. The concept full cost means that we have to identify costs that are over and above our operating expenses. As a reminder, the term nonprofit just relates to our tax status and is not meant to be confused with a business model of not making profits or surpluses. So what does the term full cost mean? Full costs include day-to-day operating expenses plus a range of balance sheet costs for short and longer term needs. So for example, full cost includes the total operating expenses plus working capital, reserves, fixed asset additions, and also paying back debt. Our goal is to generate surpluses sufficient to cover these longer-term needs year over year. Although the need to build surpluses is important, some of our clients often tell us that their funders don't want to fund them if they see a surplus. So what should they do? Through a concept called below-the-line budgeting, we can begin to not only define for ourselves how large a surplus we need, but we can also use our budget as a communication tool to articulate to funders the need for our surpluses. So let's unpack this concept of below-the-line budgeting. What does it mean? So below-the-line budgeting is a tool or a framework that nonprofit leaders can use as a strategy to not only show the purpose and intention of their surpluses, but also address the full cost of operating their organization. So as the slide shows, typically many of us budget operating revenue just to cover operating expenses. We budget to break even or zero every year. Many of us focus on this line, if you will, the line in the budget that shows the answer to the equation, operating revenue less operating expenses. But as we've just discussed, there are more items to consider when employing strategic budgeting. So working capital represents short-term savings to help with cash flow needs. Working capital can cover expenses while you wait for contract reimbursements or grant pledges to come in and convert to cash. Reserves, this is what we think about as your longer-term savings or the safety net or nest egg. Savings to help cushion against major risk or uncertainty, or to be able to pursue opportunity that may arise in the future. An organization may owe debt and need to pay back principal as a part of the obligation. Now, the operating budget will include interest on debt, but principal is not included. Therefore, if an organization has a mortgage on a building, a line of credit, a bridge loan, it is responsible for paying back principal in a timely fashion. The amount of principal due in that particular year should be included below the line. Do you need to purchase fixed assets such as equipment or make leasehold improvements to your facility? Well, you can use below-the-line budgeting to track and record any fixed asset additions as well. We've talked a little bit about the full cost that an organization can incur, but don't forget about those one-time revenue or one-time costs that you may receive, and one-time expenses you may pay out. It is important to segregate this activity below the line as well. The goal is for us to become more strategic with our budgeting, to understand what a more accurate picture of operating performance for budgeting purposes looks like, to understand what is repeatable and recurring, what we can depend on year after year. But we don't want to lose sight or dismiss those non-operating activities. We want to include that activity below the line as well and try to break even after all these longer term, more one-time in nature revenue and expenditures. So as review, operating revenue and expenses are usually regular and repeatable. Non-operating revenue and expense are usually irregular, episodic, or special in nature. Here are some examples. So on the revenue side, capital campaign contributions, for example, a grant to buy a new vehicle, a large-time sizable gift or bequest, one-time capital infusion that builds the organization's capital base, so a one-time addition to build reserves. On the expenditure side, you might consider the following: a large one-time expense such as legal fees for a lawsuit, or costs related to a rebranding effort, or severance pay. Note, most don't budget from scratch each year, so make sure that you tease out the non-operating items from the previous year so as not to budget for them in the operating expenses in the future. So let's turn to the case study. Let's see how our fictitious executive director, Jordan Johnson, of Help for Homeless Youth, HHY, expanded her budget to think more strategically about her longer-term needs. We introduced Jordan and HHY in our webinar last week. You will see in the graphic on the slide that we have inserted a non-operating section at the bottom of her budget. And it includes the following line sections. So non-operating revenue section and non-operating expenditures and other items. So let's go out to the spreadsheet and help Jordan fill it in. I'm going to get out of here. There we go. Here's our spreadsheet. So Jordan believes that she's going to receive a one-time $15,000 grant from the Laura Lee Foundation to purchase a van of a similar amount. So let's enter both in now. $15,000 in non-operating revenue, and then we're going to go down here, new fixed asset purchase, $15,000 to purchase that van. She would also like to budget $1,000 for either repairs to the van or set aside in a repair and replacement reserve that she can tap into later. Note that you can also budget depreciation as an alternative method, but make sure not to double count. So here's the $1,000. And then lastly, she would like to set aside at least 1 week's worth of expenses into savings, roughly $16,000. So there we go. Now, let's go back into the PowerPoint. There we go. And let's advance. On this slide, you can see the addition of the amounts and also the notes or assumptions on the side here. Also, you will note that HHY had a surplus sufficient to cover these below-the-line additions. Here's her surplus, her operating surplus, and it's covered everything, and she still has a surplus down here. You may not be in that situation. However, I would suggest that you begin the process of budgeting below the line. This is an important goal-setting tool. It will not only help you think about how to raise additional dollars to fund these expenditures, but it can also help facilitate a conversation with your board about how to achieve some of your longer-term goals. When nonprofits budget for their full costs and communicate their full capital needs to funders, they put themselves in a better position to avoid crises and provide uninterrupted services for their communities. Covering full costs as both a nonprofit budgeting practice and a philanthropic strategy will allow leadership to stay focused on mission and outcomes. Now, Rashi, do we have any questions thus far?
We actually do. So there was a question about, so the question is, are depreciation and maintenance mutually exclusive? You can repair a vehicle and it will still depreciate.
That is a really good question, and I hope I can answer it in a very efficient way. So absolutely. So depreciation, the concept of budgeting for depreciation is, let's say we have this vehicle and over time it is going to essentially need repairs and replacements, right? But in the first couple of years, most likely it won't. And so what we want to do is calculate an amount for depreciation, and let's use our example. She purchased $15,000 of the vehicle. Let's say it's a 5-year useful life. That's going to be $3,000 that she can set aside over the next 5 years. So let's say she does that. She sets aside $3,000 and it starts to build up a reserve. In the beginning of that new fixed asset, she's not going to be drawing on those reserves to make repairs or replacements, but as the reserves build up, she will have something in the future from which she can draw. And I'm going to stop it right there. There's so much I can say on the subject, but I don't think they're necessarily mutually exclusive, but they can work together. All right, Rashi, I'm going to keep going with the presentation, and we're going to break for another question maybe in 15 minutes or so. All right?
Yep, sounds good.
Great. Okay, so while Jordan felt pretty good about her first foray into below-the-line budgeting, she admitted that sometimes she finds it really challenging to forecast contributed revenue. Forecasting unknown or uncertain revenue can be tricky and can increase risk in your budget. It would be helpful if we could create a system to be able to quantify both the certainty and the uncertainty that exists. For instance, an executive director may not know which grants will be awarded or when, or if the annual campaign will resonate with donors, or if the new show or exhibit will be a hit or miss the goal. This is the nature of our sector, and the risk is one of two things. One, sometimes we may simply plug in an amount so we aren't in the red, or the opposite, we may be overly conservative and never plan for the right size of mission delivery and organizational investment. One way you can manage this uncertainty is to predict the probability of your revenue. So to begin, you can grade your expected revenue. We suggest using the letters A through E to distinguish different levels of risk for each revenue source. So A would be for the most dependable, B less so, and so on. Next, you assign each level of risk a range of probability. You can even color code each level of risk like we've done here. I use the letter grades, the percentages, and the colors to appeal to different audiences. Some people really like the letter grades, others gravitate to the numbers, and still others respond best to colors. Next, you will assign each revenue category, or in our example that we're going to show you, each grant award in a percentage that indicates the likelihood of receiving that grant in your next fiscal year. There are a few methodologies. I will discuss two ways today that you can use this probability information. First, the discount method, where you multiply the expected grant award by the probability percentage and then add up the discounted grant awards to arrive at a total. For instance, on the slide, we have an example of a $20,000 grant that is 75% likely. So we multiply $20,000 times 75%, and that would give us $15,000, and $15,000 would be included in the budget. This methodology is effective if you have a lot of different revenue sources or if you use the information in the aggregate. You can also use the cutoff methodology that takes the sum of the full amount of all the grants above a certain threshold. In this case, we don't discount any of the grants, but use the entire amount of the grants that are expected to come in over a certain probability, let's say 75%. So for instance, in our example we used on the previous slide, we would count the entire $20,000 in our budget as we've assigned a 75% probability to it, and it meets the cutoff. Using either of these methodologies will help you to refine your forecast and give you greater confidence in your revenue pipeline. And you can use these probability methodologies to arrive at a range of revenue you expect to receive for the upcoming fiscal year. So let's use HHY's 2018 foundation grant to illustrate this concept. In her budget, Jordan included a list of funders that gave her a total of $535,000 for foundation revenue. After our conversation, she explored the two methodologies to come up and compare and determine which to use for this budget cycle. Jordan started by first coming up with a probability ranking and probability guidelines for each letter grade. And then second, she assigned a letter ranking and probability to each grant. So let's move into the Excel model to see the worksheet that we added to HHY's budget. Okay, so you notice we've got tabs down here. We're just going to move into the development tab. And here's the worksheet that we inserted. So in column F, which is labeled discount revenue or discounted revenue, we have a formula that multiplies the amount of each grant which is in column D, by the corresponding probability, which is column L, and then we total the column right down here. So for instance, for the Fair Hills Foundation, we took $15,000, multiplied it by 75%, and we come up with $11,250. Likewise, in column H, she identified all the grants that had a probability of over 75% and summed the whole amounts to arrive at a total. Notice that the amounts are not discounted. So you can see that Fair Hills grant was included. Here's Fair Hills, and there's the whole amount of the grant. But Stagecoach, which is at a lower probability, was not. Now let's look at the totals. We have $470,500 in the discount methodology, and we have $520,000 in the cutoff methodology. Both of these are a little bit more realistic than the original that she started with, which was $535,000. She can now choose which methodology to use and the amounts that she will include in her overall budget. I encourage Jordan to calculate each as she has just started out on this journey, and then over time she can see which method tends to be the most accurate for HHY and then stick with that methodology. At this point, Jordan feels pretty good about her 2018 budget, and she's ready to think about the longer-term future. Let's go back in. Navigating the future is something all nonprofit leaders face. Next, we will discuss how we can best project longer-term future financial information. So why should we do projections, and when should you do them? One example would be when you're anticipating big changes. What will those changes mean in terms of finding and spending resources? When undertaking longer-term financial projections, the approach is very similar to the annual budgeting process. So first, projections give you longer-term financial visibility into your goals and priorities. A projection, like the annual budget, is a roadmap of what you want to achieve and how you intend to get there. Projections are based on mission and strategy. You begin by looking at your strategy and getting input from your budget advisory committee or your team. Then you identify and use historical trends to help inform you about where the organization is headed financially and what the financial position is likely to be at some point in the future. It will help quantify and project significant changes to your organization. So for instance, if your organization is contemplating growth, you'll not only want to project the increased programming revenue and expenses, but also the upfront capital and investment in infrastructure that may be needed for your new program or expansion. Likewise, if your organization is contracting, you'll want to project future budgets with the loss of funding and expense savings. In addition, planning dollars may be needed to build a formal game plan for consolidation. Don't forget, your organization will need adequate capital now and in the future. Whether it be fixed or working capital, your financial projection should help you make the accurate predictions about what your business needs to succeed in the future. Note that if your plans include a major facility project, you may need to create a separate capital budget to determine the sources and uses for that project. Your projection model can be simple or complex. Some models will incorporate key drivers of your business's business model. If you decide to go this route, you will then be able to change those drivers to see what the impact is on your financial results. It's often useful to introduce sensitivities or different scenarios into your projections, and we'll examine that in a future webinar. Lastly, we typically build in the current financial results into the model to be able to compare your projections against actual results to monitor the variances. This provides the feedback needed to course correct. To fully appreciate your financial position, you really need to understand three financial statements in both past and future. These include your income statement, your balance sheet, and your cash flow statement. But today, we're just going to look at projecting out the income statement. Remember, like budgeting, It's an iterative process and does not have to be 100% correct to be a useful tool. So now we're going to start with the model itself. Note just a little bit about the architecture. You can include 1 or 2 years of historical data, and I've highlighted those columns here in the tan. Use the budget or forecast for current financial thinking. The 2018 budget is included in this example. Note that we've incorporated a non-operating section. This is the below-the-line budgeting section that we discussed earlier. And we've also included a net assets with restrictions section at the bottom of the spreadsheet, right here. Also, don't forget to make good use of the notes column to outline your assumptions. Now let's go into the tools. Okay, we're going to go into the projections tab here. And we are going to start with expenses. They are the most known, relatively predictable, and where we typically have the most control. So salaries usually represent the largest budget item and can be influenced by a number of things. For instance, are you growing? Are you adding programs that will require additional staff? Or are you eliminating some programs and therefore reducing staff? Do you have positions in some non-program areas to fill over the next few years? When was the last time that you gave your staff raises? And how about benefits? For the purposes of our time together, we will assume that Jordan does not have any major plans for change in her programming. So let's go in, and we're just going to pick a few examples here. So Jordan gave her staff significant raises last year, but did not give her program director or herself a raise. So we're going to put in a 3% raise to start for each in 2019. And I'm going to multiply last year's salary by multiply 1.03. And there we go. And you can see I've carried it out for the remaining years there. Now, the program director will do the same thing. We're going to multiply her last year's salary by 1.03. And there it carries forward. We're going to keep those salaries flat for the next 2 years. I'll do the same for the program director. So Jordan would love to give everyone else a raise, but she's not sure that she can afford it this year. So for the first couple of years, she's going to keep those salaries flat and then entertain raises in 2021. So all we do is grab this over here so you can see 52,000, 52,000. And then in this last year, you can see that I multiplied by 1.03. So let's move to the occupancy section. Rent is a very specific calculation based on the rent amount found in the lease. So for instance, she has a long-term lease and pays roughly $13.25 per month with no escalators or increases in the lease. So we can multiply this by 12 and keep this flat for the remaining years. So we're just going to do a formula, 1325 times 12, and it remains flat for the rest. Now, some expenses can be affected by inflation. For instance, program supplies. So let's multiply last year's number by 1.02. Okay, I did not do that. I did not multiply. Times 1.02. And I've done that for each year. You can see in the formula up here, we're just going to increase that by inflation every single year. Some expenses can move incrementally, like education and outreach incentives. Let's keep it flat for the first year, and then let's increase it by 500 the next year. And then lastly, we're going to keep it flat for the following year. Other expenses could be kept flat or zero growth for the entire period. Let's look at volunteer incentives down here and keep that flat for the entire period. Now, all this means is that the program director will have to keep within budget in spite of any future inflation. Now, we're going to move all the way down the spreadsheet to contingency. I suggested to Jordan that she include this as a just-in-case line item. It's not easy projecting out 3 years, so I feel it's important to include this line to give you a little bit more flexibility. You could calculate it by using a percent of expenses or not, but for illustration purposes, I'm going to calculate it based on 1% of the previous year's expenses. And we're just going to keep that flat. So let's go back up to the top of the spreadsheet to revenue. Because she is not anticipating any major changes in programming, we can start looking line by line. So first we see program income. In talking to Jordan, she believes that her program is strong and she'll continue to grow in the future. So let's put in 85,000 just to be a little conservative in the first year, but 90,000 in the second year. Oh dear, 90,000. Okay, bear with me. Sometimes I have to go to another spreadsheet. There we go, 90,000, and we're going to keep that flat in 2021. So let's open up contributed revenue, which is already open. Jordan has thoughts on each of the foundations. For instance, ABC Foundation has been a funder of HHY for a very long time and always at the $85,000 level. However, the NF Foundation has changed its strategy and HHY can no longer expect to receive funding from them. So we'll type in 0. You get the idea. We need to understand the history in addition to current thinking on each one of the funders. Also, don't forget about the revenue tool that we introduced earlier. That can be a useful framework to help you in thinking through the less certain elements of your revenue in each future year. Now, we're going to move down to the bottom to the net assets with restriction area. Here we go. So the Sunshine Foundation gave HHY a 2-year, $240,000 grant in 2018. In 2019, they're going to release the remaining 120. Notice when I entered in this negative 120 on line 178, if we go back up to the revenue section above the line, we can see line 52, net assets released from restrictions, and it populates automatically. So let's continue this thinking. Let's say that Jordan is fairly certain that the Sunshine Foundation will continue to make these multi-year grants. So we're going to enter 240 in year 2020 and then release 120 in 2020 and also negative 120 in 2021. And again, if we go back up, you can see that it's populated here. Lastly, let's take a look at the non-operating section. So for now, Jordan is thinking that she will set aside $1,000 every single year for either maintenance of fixed assets or to set aside in a repair and replacement reserve. In addition, she is committed to setting aside approximately $16,000 for savings. Note that this is a very high-level primer just to get you started. We want to project out our financials as if nothing big is happening over the next 3 years. Then, from there, we can include strategic opportunities and are thinking about mitigating risks that we face in the future. We have upcoming webinars, as I said, on growth planning, program economic analysis, and scenario planning that will help you layer in more complex thinking on top of this analysis. Also, don't forget, this is meant to be an iterative exercise that will change as your assumptions and thinking changes. So let's go back into All right. And so here's Jordan's updated projection template after her first iteration. What do we notice? Well, first, at a high level, she's projecting operating surpluses in 2019, 2020, but not 2021. So 2019, 2020, 2021. However, after non-operating items, she's projecting deficits for all 4 years, and you can see that here. She wanted to know if she should adjust the non-operating section's assumptions, either eliminate or reduce the amount. Not so fast, Jordan. Like I said before, this is an iterative process, and this is just the first iteration. She should continue to look through all areas of her budget and make refinements. We don't want to reduce or eliminate any of these below-the-line items. If we keep them in, there is more likelihood that she'll actually be able to meet these goals than if she reduces or eliminates them just to make her budget balance. Now that Jordan has a baseline projections, she may be ready to be able to start thinking about bigger and more strategic questions. But before we get to that part, let's open it up for questions. Is there a question from the audience?
Hi, yeah, Alice. So a question just came in. Why do you include the repairs, replacement, or fixed assets in the non-operating section? Is that different from standard depreciation? If so, can you explain?
All right. So you're right. Standard depreciation would be included in the operating budget above the line, but depreciation, as you all know, is really just an accounting calculation of the wear and tear that your vehicle or your facility will incur over time. It's not all that exact, but yes, you do include that above the line. Now, for budgeting purposes, I do want you to be careful about double counting. So if you have a depreciation line item in there already, and let's just say Jordan did, she had some previous equipment and it was in there already, but through her budgeting process, she's thinking about the future. She's thinking that she wants to, purchase this vehicle, and she knows that she wants to contribute over and above what she's already calculating in depreciation that's been included, from the past. And this is just kind of a way not to forget about the new purchase of equipment that you have, and that it will require care and feeding as it goes along. So this is kind of an addition to the depreciation that's already in your budget, but they're very similar. I like to keep them separate because depreciation is that accounting calculation that's done, and you can get that from your auditor. But for anything new, or if you're trying to project something new in the future, I think this below-the-line budgeting helps us to do that. All right, I am going to continue. Let's see. All right. So once we put our baseline thinking into our projections model, we can now focus on the future risks that we face or opportunities that we are pursuing. What are some situations that might require longer-term planning? What questions can we all ask? Do we face potential funding loss? How does the current political situation affect your organization? How about staff turnover? Are you planning on pursuing strategic partnerships? Are you contemplating major growth or contraction? How do you know that you are ready to take on any future opportunities? And how can we use the resources that we have to more effectively reach our goals and navigate risk? First, let's look at the risks we face and the opportunities that we are pursuing and ask the question, what's in our control and what's out of our control? You could rank them with a 1 to 4 rating, for instance, but there is a little bit more to it than that. We find that this decision matrix is a helpful tool in prioritizing risk and opportunity. So first, you will fill in each risk or opportunity on the left-hand side here. And then you're going to come up with a handful of criteria at the top, and these are just some of our examples. We've done this for many of our clients, and the template that you see here is super simple, but it's just to give you an idea. So, using this example, Jordan has completed the worksheet by filling it out with a number of risks and opportunities that they're trying to assess. All of these things in and of themselves can be overwhelming in terms of what to address and when. So writing them down all on one page and looking at them against a set of criteria and maybe highlighting them with color, as Jordan has done here, will make it easier to sort through and figure out what to address and when. Once you have all the data filled in, you can then sort and rank the risks and opportunities. So let's actually pause here and do that now. Rashi, can you read the poll question for us?
Sure. I'm going to launch the poll. So the question is, which opportunity/risk should Jordan address first? Partner for advocacy, increased demand for existing services, new program to focus on children, or reduction in foundation grants? So I'm going to give everyone a few minutes to put in their vote, and then I'll read out the responses. Just going to wait a few more minutes. I think this has everyone thinking.
Although, you know what, Rashi, what I was thinking about is it would be helpful to actually look at the slide while they're answering the question. I don't know if we can pop back out, look at the slide, right, and then re-poll the audience. Can we do that?
Let me try. Oh, I don't think we can. So I am going to close the poll. And let's share the results. I'm very sorry if
That's okay.
people didn't get a chance to put in. So majority of the people responded that they should focus on, Jordan should focus on reduction in foundation grant. That is 44%. 31% said increased demand for existing services. And then 13% said partner for advocacy, and the same 13% said new program to focus on children. So back to you, Alice.
Great. Thanks, Rashi, and thanks, everybody. And sorry for that. You know, you put these things together and you don't think about, oh, yeah, they need to see the slide. All right. So there's no real right or wrong answer here. Though, like a lot of you, I would pick this reduction in foundation grants. First of all, I see a lot of red here on the line, and the time horizon says immediate. She has also little or no control over it. This is the one that I would address first. So once you have prioritized the data, you can use the time horizon column here to help plot out the opportunities and risks across the year. And then you can use the information in the financial impact part here to begin to model out and then insert into your projections. So a couple of notes. This can be either a high-level or relatively detailed exercise that can be completed at the staff level and then explored with by the board. Second, it's mostly a qualitative analysis at this juncture, as you can see, with the use of very few numbers. Lastly, we have noted the color scheme. Jordan will want to pay attention to both green and red in order to prioritize. And Rashi, if you could mute yourself, that would be great.
I'm sorry.
That's okay. So We are at the end of our webinar, but I do want to run through some of these takeaways. We want to build a strategic budget that reflects the organization's strategies, goals, and priorities. We want to budget to a surplus in the context of full cost. We want to use detail to show how a surplus will contribute to longer-term needs, and don't forget about including non-operating activities also below the line. We also want to provide a clear picture of revenue reality. As a reminder, you can use the cutoff or discount methodologies to address revenue visibility. Projecting your budget out 2 to 3 years can help you have a more strategic and longer-term focus, and you can qualitatively explore new opportunities or ways to mitigate risk by using the decision matrix. Don't forget to always monitor your progress closely. And lastly, communicate often and clearly. Use your strategic budget to garner support for your plans from selected stakeholders. And so before we move to the next slide, Rashi, let's open it up for a little Q&A. And I see we have, about 8 minutes left.
Yeah. So actually, there was a follow-up question to the earlier one that we handled about the vehicle. So the question is, if a vehicle is needed for a program, is it still considered a non-operating expenditure?
So that is fabulous. That's a great question. So yes, it is. For longer-term fixed assets that will have for many years to come, we need to put it below the line because it's a large purchase, and the way it kind of gets back into our operating budget, if you will, is through that depreciation line. So once she purchases it, she will then, let's say, depreciate it by $3,000 every single year. And in future budgets, she will incorporate it. And that's how, and in fact, if you do your budget allocation, according to program versus admin and fundraising, you can then allocate that depreciation into that program area, and it will be captured that way.
Got it. Okay. So there's another question. So should everyone build out a projections model?
So that's a great question too. So not everybody needs to create longer-term projections. So for instance, if your organization is not substantially changing, you may be fine just projecting out 1 year at a time. Really, it's kind of a cost benefit. You really have to look at the investment needed into putting in the time of creating these longer-term projections versus, having to spend time on other things as well. So I would say it's kind of a luxury to be able to do this. Having said that, if you are going to anticipate large change, or there's something in your strategy that is saying that, something big is on the horizon, whether growth or contraction, a new program, maybe even, collaboration with another nonprofit, those things you really do want to start to quantify, and your basis for the future are those longer term projections. And as I say, what we covered today was just, kind of the baseline, and then layering in those, new growth opportunities or new collaboration or partnership opportunities. You can layer that in on top. So really what I want you to do is just think about the investment of time versus, kind of what's needed to be able to give you kind of vision for the future.
Okay. So one more question. Below the line items seem really to be addressing cash issues. How is your below the line exercise different than plotting cash outlays and income?
So I'm not quite sure I understand the question fully, but I'll give it a shot. So with budgeting, I kind of think of budgeting kind of as in an accrual mentality, where we're thinking about all the opportunities that we have, the revenue that we expect to get in, and also the expenses that we expect to lay out. And that's the same to me with the non-operating section as well. Now, next time, and I don't want to steal Nicole's thunder, but we're going to go into talking about cash flow planning and specifically looking at taking our budget and looking about how the budget flows in terms of cash in and also cash out. And so I know that we're going to address that question more specifically next time that we meet next week. Feel to write in a follow-up question if I didn't answer it, completely to your satisfaction.
Okay, I'll relay that if they send a clarification. So I think we have time for one more question. So would executive director transition count as a reason to do a multi-year projection? They think the answer is yes.
Okay, so an executive leadership or an executive director transition. Actually, could you repeat the question one more time?
Yeah, so I think it is regarding the multi-year projection. So if an executive director is transitioning, would that count as a reason to do a multi-year projection?
Got it. That is a good question, and I would say absolutely. That's a pretty big change. And what you'll want to do is, maybe do some scenarios in terms of when the leadership is expected to leave. Is there going to be interim leadership? When is the new leadership going to come on? Also, recruiting expenses, planning, certain planning expenses. There's a lot going on there. Now, you maybe 2 years or even 18 months is significant. Well, I would do 2 years of planning there. And also, just a plug for below the line budgeting, anything relating to that, like your recruiting expense, in theory, is going to be one-time in nature, right? Or any specific planning expenses are going to be one-time in nature. And so you could consider, if they're relatively material, put those down below the line. But I agree with you, Rashi, and whoever wrote the question. Yes, I think that's a great reason.
Okay. So I think we are ready to close. And thank you, Alice, for this great session. I learned a thing or two. So before we close, I'd like to remind you all that there is still time to register for the remaining webinars in our 14-part series. And there are plenty of packages offering, which provide a 15% discount of multiple webinar series. Webinar sessions. Next week, we're going to have Nicole, who's leading a session on cash flow planning. Cash flow has a great influence on the success of your business, and if it isn't managed properly, it could disrupt your operations and decision making. So this webinar will teach you how to accurately forecast your cash flow and anticipate and mitigate problems early on. Following the close of the webinar, you will be redirected to a feedback survey unique to today's session. Please do give us your feedback on your experience today. We'd love to hear from you. Also, just as a reminder, I will email you the webinar recording, slides, and all the supplementary materials within 24 hours of today's session. And finally, a big thank you to our partners listed here. We are honored to work with them, and each of them are critical to the success of this series. Then please visit on our website or social media if you'd like to learn more about any of our services, messages, or publications. I really hope you all enjoyed our conversation today, and we look forward to connecting with you in the future. Thanks again for joining us. Goodbye.